Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's pifinancial.com and polarfuturesgroup.com. Welcome back to the show, Drew.
Thanks for having me on again, Jim.
Drew, we've seen an escalation of the U.S.-China trade war. Last week, that caused a sharp market sell-off. Equities started off higher this week, but what's the overall market reaction to this? It seems to be increased trade fuss between the U.S. and China.
Yeah, I would say over the last month, the equity market, that is the U.S. equity market, has seen several sharp down days. And then we see sort of bids that come into the market to follow that up. So as choppy as it's been, the S&P 500 really hasn't gone anywhere in the last month. It's stayed in a pretty tight box. The S&P over the last year hasn't really gone anywhere. We're back to levels that we were about 12 months ago. So there's been a lot of volatility as there is a lot of uncertainty in the market. And I do think that when we see those big down days, the market does panic, as it does when sharp sell-offs are happening. But it also projects what could be the worst case scenario, and that's what investors tend to get worried about. So on Friday, the escalation of the trade wars had everybody worried how bad it could get, how bad it could get over the weekend. We also had the G7 meeting in France over the weekend, so investors were probably thinking how poorly that could go and where that could have us opening on Monday. So after the G7 over the weekend went fairly well, there wasn't really a further escalation of trade issues between the U.S. and China, and some may argue there was actually a bit of a de-escalation with some of the headlines over the weekend. But again, we kind of saw in the futures market, we gapped lower on the Sunday, and then since then have largely just traded up as some of the uncertainties remain, but the ultimate fear of what could happen is worse. And then I would also say that we see during the last month, when we see these big sharp sell-offs to the downside, they're pretty heavy volume. And then when we see the rally back days, they tend to be quite low volume and pretty quiet. And again, I would remind people that we are in the last week of August, going into a long weekend, both in Canada and the United States. So there's a lot of people away from their desks this week, sort of taking the last bit of summer vacation. And a lot of the time we can see some of these market moves come back and maybe come back in earnest and maybe see some more trends in a direction rather than just this tight choppiness that we've seen when we come back to work in September. So that'll be an interesting thing to keep in mind for when we come back next week.
Well, it seems to me, though, over the last few years that when people predict something's going to happen in the market in September, it usually starts a week or two early, and it doesn't matter what time of the year it is. Everything seems to happen a little faster now. Is that because of computerized trading? The robots don't take a lot of time to think things over.
Yeah, there is always the advantage of trying to front run what the trend will be. So anytime a market really moves, you can always make the most money if you can get in early, get in front of it, and then be selling when the final buyers are coming into the market. So that game right now tends to be getting in front of central banks. Central banks tend to do things slowly, but in the same way over time. So with central banks moving to cut rates and possibly add to different types of quantitative easing, there is the idea that you want to front-run different instruments in front of that, whether that's getting into the bond market because bonds will go higher as yields continue to go down, whether that's getting into different assets because asset prices will go higher because of that. So the expectation is that if you see something coming, you can get in front of it. I would say the algorithmic trading that you hear people talk about will be on a shorter term basis and definitely can create more noise, and with that some opportunity on a short term basis that maybe on your hourly charts they're pushing things further than you think they should go, or that are reasonable, and then they'll come right back again the other way. So I don't think that gets in your way if you've got a medium to longer term time frame. On the short term, yes, it can definitely create some further noise and confusion as moves happen very quickly, and especially in an environment of sort of headline risk, whether that's tweets from the Trump himself or other participants or the central bankers. You do see the market reaction happen quite quickly, as those algorithms will pick up those headlines and trade on them faster than we'll even see them come out. So there is just definitely that, again, heightened level of fragility, I would say, as it's a lack of confidence in the positions that you have, because we can see such abrupt changes in the market on a single tweet that wasn't a scheduled release. So you always have to be on edge and ready to react in these markets, which makes them tougher to trade. But again, I think can provide some opportunity as some of the short-term moves get pushed maybe a little further than they should if it lines up with your sort of medium to longer term time frame.
We'll have more with Drew Zimmerman right after this.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Drew Zimmerman. Drew, if the headlines hold so much sway over the markets, how is someone supposed to trade or invest in this kind of atmosphere?
Yeah, as I was just saying before the break, the market reactions to these tweets, that again we don't know when they're going to come out. We don't know when U.S.-China headlines will come out about whether a phone call happened or didn't happen, or if tariffs were raised. The word I used was a fragility of the markets, and that I think is because there's an uncertainty of your position if things change, and they can change so quickly with those headlines or tweets. So it is tougher to trade in those environments, and the noise can be a lot higher. The noise, I would say, is your swings on a short-term basis, and how big those swings can be have definitely increased. So I think the important thing is to take a step back to see where your general trends are. Trade with the time frame that is a little longer than where that noise level is, and that'll help sort of cushion you from that. And then just the sizing of what you're doing, whether it's individual stock purchases or different commodities. If you're investing less, then the bigger price swings have a smaller hit on your P&L. So that's I think the best way to do it, because I do think that as we go into the fall, this choppiness, this volatility, these sharp swings are likely to continue and maybe get even bigger as we get out of the quieter summer months that are normally quieter. But we'll see. So again, just taking a step back, having a little longer time frame, seeing where you want to be over the coming several months or half a year, and then maybe use some of these over-aggressive moves as an opportunity to get in or out of markets that you might be in.
Warren Buffett's Berkshire Hathaway is holding 59% cash right now. Is that a good idea for people? Go to cash and then wait for things to settle out and let the dust come out of the atmosphere and land on the ground?
Yeah, I think it's never a bad idea to be holding cash. I think as we see interest rates go lower, there's less risk to holding cash. If you're in the bond market, you're getting paid less and less to be in bonds. If you're in a longer-term bond instrument, you've seen good capital appreciation at this point. So, having some cash is never a bad thing. That always allows you to take opportunities if they do present themselves, depending on which markets you're looking at. So, getting up over 50% cash is definitely a very cautious position. I think that you need to sort of align how large your cash position is with your sort of investing goals over the medium to long term. I do think, as I was saying, that some of the volatility that we're going to see as we go into the fall, as we sort of digest this ongoing trade war, and what I see as a slowing global economy, will provide some opportunities that are likely better than where we are now on the equity side of things. On the bond market, we've got the U.S. long bond at all-time lows on the yield side, bonds moving at their highs. So, where that opportunity is going to look a lot different. The good thing with the bonds moving as much as they have, a balanced portfolio of stocks and bonds have performed very well this year, and the bond market's done a really good job of being that hedging component for the times when your equity portion isn't doing so well. So, having a little bit of cash, always a good idea. Going to 50% cash is definitely a bold statement that you think things get a lot worse. But if you're right, it can pay off better. But if you're not right, then you're going to be, a little behind on where your returns are over the medium term.
Going back to the trade war between China and the U.S., one of the positions that China has that gives it an advantage over the U.S. is that it's the world's biggest supplier of rare earths. However, it turns out that Denmark's Greenland is also full of rare earths. Was that perhaps the reason why Trump was thinking about trying to buy it?
I'm not sure. I don't know that I could shed any additional light on that. I think it's hard to know what Trump is thinking and why, and trying to postulate on maybe that big grand of an idea might be giving him a little too much credit, but hard to say. I really can't say why you'd want to be going out on a limb to buy Greenland.
We'll have more with Drew Zimmerman right after this.
Juan Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, is this amount of uncertainty why yields keep moving lower?
Yeah, I think it has a big part of it. I think this uncertainty is pressuring central banks. We see central banks around the world cutting their interest rates. In the U.S., I mean, we still have what I would say are the highest rates globally, and it is the world's reserve currency. And part of that is they're supposed to have cheaper funding costs, and obviously, given what central banks have done in other parts of the world, that's changed that in the sense that the U.S. 10-year is 2.5 basis points above where the German 10-year is 2.5%. Sorry. So I think there's sort of a global gravity, to use that word, that has sort of clung on to where U.S. rates are now, and if they are so much higher that they get kind of pulled down to more the world average. So I think we're seeing that happen. The U.S.-China trade issues are definitely causing some grief and worries about slowing global growth. So that has its impact where people want to go into a safer asset, and right now we've got the U.S. dollar quite strong. So if you've got a currency that's doing quite well, and the highest yielding safe paper globally, I think that just encourages people to bring their money to the United States, invested in safe assets such as treasury paper, because you're still getting a return on your money, where in a lot of the other developed world you're seeing negative returns. You're actually paying somebody to hold your money, paying the German government to hold your money for a period of time. So you're going to be disincentivized to do that, more incentivized to bring your money over to the U.S., where, again, you can get a return on your money and safety of your money as well.
With global rates heading lower, central banks around the world cutting interest rates, again dipping into negative in some places, do you see the Bank of Canada also continuing to cut rates?
Yeah, the Bank of Canada has been the one sort of developed world where we've been able to sit on the sidelines, and we've had some better economic data in Canada in the last couple of months. Our employment situation's done quite well over the past year and a half, and that's allowed the Bank of Canada, after they were raising rates, to not have to cut rates. So we've the Bank of Canada sat on the sidelines. I think that's likely to continue at their next meeting. I don't think they're going to jump out and cut rates again. Inflation's been strong enough. Employment's been relatively healthy. I do think they will sort of sound the alarm bells on being a little worried about what's happening with global trade. And again, with all the other central banks cutting their rates, it is a bit of a relative game where I don't think the Bank of Canada can stay on the sidelines as other central banks, cut and continue to cut. So I do think it is coming for Canada. I think we will be able to stay on the sidelines and stay steady with rates near term. But again, with a country that depends a lot on our exports, when we're exporting less and the global economy is slowing, and especially if we saw U.S. consumers, which have stayed very strong, if they start to slow, again, that's a big export market for Canada. And again, just increased uncertainties. The Bank of Canada and POLAs, especially, I think, has always done a very good job of trying to get out in front of uncertainties. The last couple that they've had to face has been more related to oil prices and the oil shock that came into the Canadian economy. But again, he sort of showed his hand in that he liked to sort of get out in front of that before it got as bad as people thought it might. So I do think they will be preemptive, but I don't think that means they cut rates at the next meeting. I'm looking more towards October for the Bank of Canada.
If the Bank of Canada lowers its interest rates, what impact will that have on the Canadian dollar?
Yeah, that's a very good point. Watching interest rate differentials is always a key for me when looking at the Canadian dollar exchange rate. And they've been moving in the Canadian dollar's favor over the past couple of months against the U.S. That hasn't helped Canada as much as it would normally. And again, I think that's because there is more uncertainty. Canada is more of a commodity, exporting nation. We see the nations of Australia and New Zealand are similar, much more dependency on China, but those currencies are at multi-year lows where Canada isn't. So they've definitely outperformed to the downside. Canada's stayed relatively strong on that front. But I think if we start to transition from having the Bank of Canada, which is expected to stay on the sidelines, if they come out with a more dovish, that is a more cautious tone at their next central bank meeting, then I think the bid into the Canadian dollar could come out a little bit, as they're seen to be joining the rest of the central banks globally in cutting rates, as well as you see crude oil sort of staying at this mid-50s level. If this global slowing story does pick up any steam, then I think Canada becomes vulnerable as it's a commodity exporter. So I'm cautious on Canada now. It's held up at the 75-cent level quite well. However, I think if the Bank of Canada does give us a dovish tilt, the more likely scenario is going to be Canada break down through 75 cents. And then I think we could retest recent lows in the 74, 73 cent range rather quickly. And that's also on the back of, again, I think there's just more reason for international investors to be coming into the U.S. dollar, getting higher yields in the U.S., and that bigger, stronger U.S. dollar just has a negative impact on the Canadian dollar as well.
Gold has rallied over $250 over the past 3 months. Where's it going from here?
Yeah, gold has been incredibly strong, and I think there's several reasons for that. Obviously, the global uncertainty, trade war issues that we've been talking about. There's also been some geopolitical risks between what's going on with the U.S. and Iran, again, some more missile launches out of North Korea. And then there's also the Indian and Pakistan issue that is going on with the Kashmir region. So there's a lot of geopolitical uncertainty. And then on a more fundamental side, again, with interest rates moving so much lower globally, we're seeing real yields have a strong impact on gold, and I think that allows gold to do better. And that's where gold is doing better, even though the U.S. dollar is doing better. So when you look at gold in terms of other currencies like the Canadian dollar, gold's at all-time highs, looking very strong. So, when it is in a bull market, you see it going up against all currencies, and even the U.S. dollar. So this move in gold has been very strong. I think it's getting a little exhausted at these levels. It's had a very sharp move in the last 3 months. A lot of investors have piled in. You see open interest is quite high. The speculative positioning on the CFTC data, very high, nearing extreme levels. That's not to say that, again, this continued uncertainty can't continue to push the market, but it is looking a little exhausted to me. So I'd be a little cautious at this point. However, I do get the feeling or the sense that there's a lot of people saying, I'll just get into gold once it pulls back a bit. And when you have that kind of a market, it tends not to give those investors what they want. So any pullback might not be as big as we would normally expect, when a market gets overbought like this, especially if we go into a fall that's got a lot of volatility, a lot of continued uncertainty. Gold might have started a move that it just doesn't look back from. So I am one of those investors looking for more opportunities to get on the long side of gold. And I think just also realizing that, hey, I might not get as big as a pullback as I want to get in. So maybe getting in with a little bit more risk than I would prefer. But again, I think near term, maybe a bit of a pullback, but over the medium term, I think a lot of reasons to be long the gold market.
Drew, thank you so much for being on the show.
Thanks for having me on again.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites, pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.